Hi, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about how to protect yourself against inflation using your annuity contracts. There are certain annuities that are best for this as far as increasing income. There's some good indexed annuities that are for that. And then you've got SPIA and DIA annuities that will give you a guaranteed contractual amount that will increase every year. You just have to realize that you either have to start with more premium into these contracts, or you have to be okay with having less income up front for guaranteed contractual raises over time. So one of my favorite ways to do this is to just create multiple contracts so that you can fight inflation that way, and that way you don't have to use as much premium. So let me show you how this works. All right, so looking at my computer, you will see that I have put someone in that lives in Pennsylvania. They got $350,000 and they're 58 and 57 years old, and they want to defer income for 7 years till age 65 and 64. So they're going to put $350,000 in, and they're going to get joint income of $41,137. Okay. If it's a single payout, it is $44,700. So a little bit higher for single payout, but if you're married, definitely stick with the joint, in my opinion. Unless you got separate assets, I suppose you could do that too. So, and when people are younger, if you got a spouse that's like 20 years younger, sometimes it makes sense to do that as well. All right, so if we look at that and say, okay, well, we know what our income is. It's $41,000, but $41,000 is not going to be worth today what it is worth now. I mean, it's not going to be worth in 7 years what it is worth now, and it's not going to be the same in 10 or 20 or 30 years, which is why you have to purchase additional annuity contracts. You don't have to do it with as much money. So you might say, all right, I'm going to put $350 in this. This is what's going to give me $41,000, and maybe you got another $50,000 coming in from pension and Social Security income. So it's plenty of income to start out with. Your Social Security is going to rise, but maybe not this part's. This part is definitely set for life. I mean, if you notice the illustration payout, it's actually level income forever. So it never goes up, it never goes down. So that's great. I mean, you're taking out almost $1.3 million from $350,000. That's a great payout. That's absolutely worth its weight in gold. But if you're looking to fight inflation, you're going to want to add to this. And so what you'll do is you'll come in and say, all right, I'm going to buy one for $350. Great. This is set up. I'm going to take it to $65. Or you can take it earlier or later if you want. If you take it later, it pays you more. Okay. So, but then I've got more money in my account. I want to set up a couple more contracts. Maybe I want to put 2 more contracts in there, and they're worth $150 each. Okay. Just make this easy. So $150 each, and we're not going to activate income on these until later. So we're going to wait until 70 to activate income on the first one. Okay, $150,000. So based off of that, it's $27,000. It's pretty good. See, now you're adding to your income. You've already started out with a ton of money, right? $90,000 a year. You got more than half of it already growing because it's Social Security income, but the other half isn't. And so that's why you add to it. And now you're at, $130,000 plus. Okay. So now we're looking at this and say, okay, we're pretty good, but we still got our third annuity contract that we're going to start. And maybe we'll start at 75, but maybe we will wait longer. Maybe we'll wait till 77. Okay. 77 is when we will activate our third contract. And again, this one was funded for $150,000 as well. So the longer you let it sit, the more it gives you. You can see right here, that's the case for American Equity. They're the highest payout if you were to put it in longer. $40,000 a year, pretty good from $150K. So now you've already had increases on your Social Security up to this point. And so your account, your income at this point might be $150K. You add 40 to it, now you're at $190,000. See, this is how you do it. You're doing it with a relatively lower amount than you would if you were to just put this in right when you need it. Like if you were to purchase annuity contracts at 70 and at 77 and take immediate income, it's not going to be as much versus putting it in now and letting it defer. So in essence, you took $350 and you purchased income for yourself for age 65, and then you took another $300,000 and divided up between 2 contracts, and those are designed, of course, to take income later on, and you can choose whenever you take those. But yeah, it's great. You only took like $650,000, and in the end, you've got several contracts. I mean, you've got, the first contract was like $40,000. This last contract's $40,000 just because you let it defer out for so long. Between all your contracts, you're getting well over $100,000 just in annuity income from only $650,000. So it's a pretty cool way to do it. Now, if you're looking for just contractual, I don't want to have to think about this. I don't even want to turn it on. I don't want to have to activate new contracts. I just want to put money in and not think about it ever again. Okay. I'm going to show you two options for that. So if you go in here and I'll just say increasing income. Okay. We want increasing income. And again, these are fixed index annuities. So this is all defined on what the index does. So I'm going to bring this right down to 65 and then I'll change this back to 350. Okay. Now again, it's going to be a lower payout because it's going to rise. See, it's a lot lower. It's not 40 grand, it's 30. If I was going to choose either of these, I'd probably choose Allianz just because I've seen these grow and they have decent growth rates for these increasing annuities. So what I'll show you is this. They have a guaranteed floor of 30,000. This will never change. This is based off of zero growth over here. So worst case scenario, you'll only get 30 grand a year. That's the risk you take when you do these increasing options with the index. Okay. But if it increases, which it probably will, then here's what it actually is going to look like. It's going to start you at 35, not at 40 or 41, whatever it was when we were looking at the level payout. But if we're looking at 35 and it continues to grow, it'll eventually get up to that level payout by the time you're like 70 or 71. So that's why sometimes people were like, I don't want to do this. It's a long time to wait till I just get to my level payment. I'll just take the highest level payment and then purchase more contracts. That's usually the case with most people. But you can see over time, this grows pretty nicely. So it's a great way to take higher income and you still have a decent payout over that time period. So again, this is hypothetical. This is based off of growth, okay? Which this is pretty reasonable growth, but it's important to remember that it's hypothetical. All right, so now what we're going to do is we're going to go to pure guarantees. So pure guarantees is a SPIA or a DIA. They are irrevocable. You cannot change them. Okay. So you have to remember, once you put money into these, there is no cash value. And a lot of people do this and they don't realize that there was no cash value and they get really upset about it. And they'll reach out to me and like, why do they sell this to me? And the advisor didn't explain it well enough. So I'm going to click here and I'll say cash refund. I'm say joint life, same 350. So I just want to make sure that there's a cash refund if we die early and we don't want the money to go to the insurance company. And then what I'm going to do is I'm going to say income start date and I'll say 7 years from now. Okay. And right here, COLA. And for this, I'm going to say 2.5. That's what I want. Mutual of Omaha is the highest one, and they start you out at $23.34 per month, guaranteed income forever, and guaranteed every year to have an increase of 2.5%. So if we look at this, let's see, $23.34 times 12, it's $28,000 per year, which you notice it started lower than even the increasing indexed option. But you have an absolute on there as far as the guarantee. But it's a lot lower than the 40 grand plus that we got from the income rider that pays you out no matter what the index does. So if you want higher income with the COLA, the only way to fix that is to put more money in here. So I'm going to change this to 550. I'm just going to add another 200 grand just to see if that does it. 3697, 44,364. So it beats it now. It's a little bit over, not much, but there you go. So if you want an absolute, I want to make sure this comes to me at 2.5% increases every single year, and I'm willing to put in 550. It's going to give me $44,000 per year in guaranteed income for the rest of my life, starting year one, and then it'll go up 2.5% and then 2.5% and so on. So that's guaranteed. That's nice. So I bet we get close. I bet 500 grand should do it if we look at that. Yeah, let's see. That's pretty close. 3351 times 12. 40,000. There you go. 40,212. So that's the perfect number. So instead of 350, you got to put another additional 150 in there to start out with the same amount and then just set it and forget it. You got the 2.5% increases every year for the rest of your life and the rest of your spouse's life. So this is a great option too, but you just have to come up with 500 grand for this particular contract. So otherwise you can purchase multiple contracts and give yourself much higher raises down the road, and you have a lot more flexibility as far as when you take income. So you have to remember with any of these contracts with the SPIAs and DIAs, you will select a date that you take income. You cannot change it. There is no cash value. You cannot get out of it. You cannot cancel it. There is no going back. Okay. So they are great contracts, but you have to realize what you're committing to. Okay. With an income rider, you still have all of the lifetime income benefits, all the guarantees, But the difference is it's very flexible. You can cancel it and get your money out. Okay. Yeah, you'll have some surrender charges if you cancel it too early, but at least you get access to your money. Okay. And you can also decide to take income at any age. You might take it at 65 or 66 or 67. And that's what's so nice about it, is it gives you the flexibility to do that. So anyways, I wanted to share these different options you have for protecting yourself against inflation and having your annuity increase over time. So I hope this has been helpful. If it has, make sure you like, subscribe, share, comment below, book a call if you're interested. There is a link below this video, it goes directly to my calendar. Or if you just want to go check out annuities and what they're paying right now, go to my website. It's johnstevenson.com, and you'll be able to see what the payouts are. And then if you're interested, you can reach out at that point too. There's a book a call link there as well. So anyways, I won't bite. I don't like to be sold. I hate being sold. I just bought a new truck yesterday, and the guy was trying to sell me an extended warranty for like an hour and a half. And I hate being sold. I detest it. I loathe it. It is just a horrible experience to feel pressured into something. And so that's why when people meet with me, they'll never, ever feel pressured, because I hate the feeling and I don't want anyone else to feel that as well. If you are looking to purchase, I hope you will book a call with me, because I will show you what is available. I will give you my recommendations. I'm not going to sit here and twist your arm. It's your money. I don't care. You can do whatever you want. So anyways, I really appreciate you watching. I hope this video is helpful. I hope that you have found value throughout my channel. I really do appreciate you watching, and we'll see you next time.